All right, I think we will start the webinar now. Again, my name is John Tansel. I am the chair of the financial services group for the firm. And with this webinar, we want to talk about, now that you have your PPP money, what do you need to do to make sure that that does get forgiven? Based on the results you've sent us, about 91% of all of you who have joined us today applied for the PPP loan, and when the results came back, 85% had been approved, which is probably higher now since they opened the portal up for the E-Trend PPP loans yesterday. So what we will talk about today is things you need to do to make sure that you will get forgiveness and how to approach your banker. Remember, the banker is the one who determines whether or not you have the right documentation in order to receive forgiveness. And then we want to talk a little bit about the steps you need to go through to maximize forgiveness of the current loan amounts. The first thing we'll talk about, and Rebecca, if you can go to our first slide about FAQ number 31, is some of the confusion which has resulted recently. Actually, there's been confusion in this program from the beginning. And what we want to do today is take some of that confusion out. Andrew Podgorny is going to be addressing what happens with respect to this new language which has come out from Treasury. Even today, some additional language came out. So Andrew, if you could just run through FAQ 31 and what that will kind of mean to people who have the PPP loans.
Yeah, of course. Thanks, John. And my name is Andrew Podgorny. I'm an attorney with our financial services and corporate and securities practice groups here at Smith Amundsen. And it's, John mentioned, the SBA and Treasury, they released this FAQ 31 last Thursday, which was intended to provide some additional clarification on one of the certifications in the borrower application, which states that that a borrower needs to certify that the loan request is necessary to their continuing business operations. This kind of came out of a little bit of public outcry that you may have heard about some public companies, specifically Ruth Chris Steakhouse, as well as Shake Shack, getting some pretty large loans through the PPP program. And so what—
Andrew, if I can interrupt 1 second. This is Rebecca Bush. I'm presenting with Andrew today, and I just wanted to mention one thing. For those of you freaking out because of all the language on the slide, don't worry. We are going to be emailing you program slides after the presentation. And, you know, so I mean, fine, if you want to take photos with your phone, sometimes I admit I do that when people are giving presentations because I don't want to write it down. But you don't have to be frantically, you know, taking pics of every screenshot. You can wait, and we're going to send all of this in follow-up. If we have a quality recording, we don't promise it because sometimes there's, you know, glitches that happen. But if we do, we will share that with the slides as well. So you can share this with colleagues if you're, you know, like, oh, you should have heard this webinar today. Although hopefully there won't be new slides or new rules that, you know, invalidate it right away. But we'll talk about that in a sec. But I just wanted to mention that because there's a lot, like this is one of the most packed slides we have in this presentation today, and that's because of the actual language from the actual FAQ. And so I didn't want people seeing this being like, oh my gosh, what did I sign up for? Also, there is a Q&A. If you need to submit a question, we're going to try to monitor them as best we can with 700 people on the line and get to them. And your lines are muted. So sorry, just wanted to mention that. Thanks, Andrew. So you'll get a copy of this slide.
No problem. Appreciate it. Thanks, Rebecca. And so kind of going back to the FAQ, just a couple of points that we wanted to touch on is that one, you know, even though the initial question language kind of references large companies, you know, reviewed in context, this type of standard is likely going to be applicable to all borrowers under the PPP program. And so, you know, we're suggesting that all borrowers, especially those which have not received their PPP loans, and even those that have, should kind of take a look and make sure that they still, in fact, qualify under this program in light of this further guidance. And kind of the two hallmarks here that the Treasury is kind of directing us to look at are, other sources of liquidity, and whether or not that's, current existing lines of credit or access to other capital of maybe some owners or something like that, as well as whether or not, being able to access other sources of liquidity, what those terms are, and whether or not those would be significantly detrimental to the business. Secondly is also, if you are a public company, it seems pretty clear that they have said that public companies are going to have a hard time meeting this threshold for needing the loan. One other point that we just want to highlight that John kind of alluded to is that this morning, the Treasury Secretary came out publicly and said that they are indicating that all PPP loans that are above $2 million will be audited after the fact. They haven't gone on to provide any further clarification, but that's what kind of the initial threshold is that they're looking at. John, did you have anything else you want to elaborate on?
Yeah, I just want to let people know that the PPP program has been rolled out with a lot of after the fact clarifications, and this is another example of what has happened here. And this is important to you because when the act first came out, it just said under 500 employees or otherwise qualifying, then you get the loan. That the economic uncertainty made the loan necessary. And there was no restriction on, well, you can't be a public company and get this. You can't have liquidity and be able to get this. And so those have kind of come in after the game almost is over. So go back and look at that because it's going to be important. The CARES Act, where this has all been authorized, does create an inspector general for pandemic recovery. And that entity will have the ability to issue subpoenas, and when you put that in with Mnuchin's comment that anybody with over $2 million in a PPP loan will be audited, makes what we're going to talk about today very important. And the reason this slide is up front, and the reason we wanted to talk about it first is to put everything we say following this in the context of making sure that our I's are dotted and our T's are crossed when we go in and ask for that forgiveness. While the government is putting things out which on their face are frightening, and I think if we walk through this step by step today, you'll get to the end line and you should feel a lot better about what we're doing. It's going to be very important to follow what we think are best practices. Some of you, and I know Rebecca will be touching on this later on, may want to do not commingle the PPP money with your other money is my best advice. And again, most of my practice is representing the banks who are making these loans and then are going to be saying whether or not we want to forgive them. It's going to be easier for a bank if you have a separate account to be able to tell that that money was used for those purposes enumerated in the application for the loan. There's no legal requirement that you do that, but I'm just saying it will make your life simpler if you can do that. Secondly, make sure that you have policies and procedures in place. And this is sort of a common sense thing, but restrict who has access to those funds so someone does not mistakenly use a PPP dollar to pay for a magazine subscription. Just use those things as best practices, which are really nothing more than common sense, and you're going to have a much easier time when you go ask for that loan forgiveness. Remember, with the saber rattling from Treasury and with the Inspector General for Pandemic Recovery being created by this act, there is also a federal statute that makes it a crime to lie to the federal government. And where they would probably come in and say you lied is when you said you needed the loan, but you really didn't. So I think that makes what we talk about today extremely important to show how you use that money and why it was important. So go ahead, Rebecca.
If I could chime in with one thought too, because I'm getting this, and if Jeff's line is unmuted, I know he has thoughts on this too, but it's the first question out of the gate these days because of how the Treasury changed course and because of the bad press on PPP loans. And you know, it is important that you're careful with it. You're entrusted with a lot of money and charged with a specific task on how to handle it. But let's be clear that this money you're supposed to be getting it and managing it by giving it to your employees, and we're going to talk about all that. But it doesn't change, you know, like, for example, the bolded text there, it says, although the CARES Act suspends the ordinary requirement that the borrowers must be unable to obtain credit elsewhere. So John and I were talking this morning, like, there's a difference between, you know, you don't have to be on the verge of bankruptcy to take the loan, but you don't want to be in a spot where you have no concerns because you got, you know, very liquid, wealthy investors like the LA Lakers and things like that. It's just a different scenario. But if, you know, you have credit that's only going to get you through, or assets that are only going to get you through 6 weeks, 8 weeks, and this might last longer, then, you know, that could be economic uncertainty. But it's a matter of documenting so that you remember when and if you are audited later, why the economic uncertainty exists today. You know, I talked to somebody who, you know, they were tied to retail, and retail is all shut down. And so they have a drop in sales, and they don't know when or if that's going to be back. Even though they had an initial surge, everything went down. So, you know, I actually talked to a couple people like that scenario this morning. So I just wanted to mention that, you know, yeah, it just means be a little bit more careful, but it doesn't mean, I mean, a lot of you that took it, I mean, I don't know your financial situation specifically. It doesn't mean you have to be on the verge of bankruptcy. John and Andrew, would you agree with that statement?
I would absolutely agree with it. And there have been some publicly traded companies which have come out and said that we're not giving the money back because we needed it. I know there's a broadcasting company, for example, that has said that just today. So it's not a requirement, but it gets back to, did you really need it? And I think part of it is to remember to keep your documentation so that, you know, at the end of the 8 weeks, you've got written records that show what you did with that money, which is going to make it easier to say I needed it also.
Right, because I mean, who here remembers what they had for dinner last week Wednesday, right? I mean, that's the problem. So that's why you document, because every day blends into the other.
So with that, Rebecca, let's go back into our next slide where it talks about forgiveness. Okay? And why don't you kind of walk through that?
Yeah, I want to give people an understanding of like where we're coming from and why some of this today is different than what you learned about in terms of eligibility, who's eligible and how much can I get, and what makes this kind of a big, you know, hot mess, for lack of a better legal term, to be informal about it. So, and I remind people, Milton Friedman referred to this, a famous, you know, economist that referred to it as helicopter money, where the government just flies over dropping money out of helicopters. And, you know, this is kind of that type of bailout, if you will. So it's just a little hectic. So the CARES Act has multiple sections and multiple divisions. Division A, each one is like its own little silo or bubble acting within CARES. So we are in Title I within Division A. So the way it's worded is that each division is supposed to operate with its own definitions, right? So under Title I, which is keeping American workers paid and employed, it's also a good idea to know the intent of the law is based on how it's titled. Section 1102 was all about PPP loan eligibility and availability. And there were some definitions in there. Then later on, you know, you have 3 and 4, 1103, 1104, some stuff about women's groups, whatever, non-related. And then you get to 1106. And then they threw in, this is how we're going to decide how much is forgiven and when it's forgiven. So it was a different section within the same, you know, bubble of the act or silo of the act. And in some cases, new definitions were provided, saying for purposes of forgiveness, this is going to be the definition. And if that's the case, we talk about that. You know, for purposes of forgiveness, these are the time periods we're looking at. For purposes of forgiveness, this is what we're looking at. Whereas with loan eligibility, it was different. Where the section's silent you know, the first step is we look back to the old one to say, well, do we already have a definition on this? But there are some cases such as, you know, 1106 introduces the concept of FTE, a full-time equivalent employee. And that there's no definition for in the statute anywhere. And I know some of the questions in advance were, what's the definition of FTE? This is one of the things we're waiting on Treasury guidance for. I know Andrew's discussed with me that we were hoping for guidance to come out by today because the Treasury and SBA were charged with providing guidance within 30 days of the law's enactment, which would have been Sunday. But we did not get the guidance we needed today before this, so we're still waiting on that. There's just a lot to manage on the front end, giving out the second round of funding and all of that stuff.
Hey, Rebecca,
so there are going to,
Yeah, one thing I just want to highlight on the kind of some of the definitional differences. One thing we've got some questions on is under this 1102 section, they talk about being able to use PPP funds for interest on other debts, such as business obligations, interest on those payments. Notably, that is not an expense which is eligible for loan forgiveness currently. If there might be some interpretive guidance that comes out down the line, but right now, we caution spending the PPP funds on expenses which are not expressly set out for loan forgiveness.
Yeah, and we'll bring that up when we talk more in detail on utilities and other things and how to spend the remaining 25% when we talk about the ratio. But it's good to point, like, that's why I wanted to kind of explain how things were structured a little bit here to say, well, wait a second, you gave me a definition on utility expenses, last month when you talked about getting this PPP loan. Well, how can you say you don't know? Well, that's because we don't know for sure if we're going to be, referring back and expanding on PPP loan eligibility provisions, or if it's going to be a strict restriction on what's in loan forgiveness and 1106. Okay. So the forgiveness factors, and Andrew's going to chime in as well. We kind of been talking about these a lot with clients in some occasions together, because it's nice working with John and Andrew and Jeff and I and everybody in the L&E group, because in the L&E group, we're typically advising employers on the employer side, right? On payroll costs, compensation. That's how we all got into this, meddling and what does the PPP mean? How do we approve leave? How do all these things interact? And John and Andrew are advising the banks on how to look at, when they're giving the money out, and they're in our financial services group. So it's kind of nice because you're getting the perspective of the attorney advising the lender, as well as, I know I've saw a lot of familiar names on the attendee list. We're working in terms of the borrower. So it's kind of like both sides of the coin here you'll get from me and Andrew. So, and John and Jeff. So, okay. The general guideline is to spend a minimum of 75% of the total loan balance on payroll costs, quote unquote. So that's a signal that we're going to, that's a magic term we have to figure out and pin down the use of in a minute. And 25% on other, allowable uses or permissible expenses. It's referred to several different ways under the Act. So,
and Rebecca, one of the questions we have received today is on payroll cost. Is that on an accrual basis or a cost basis?
And this is an important thing, and I think I mentioned it in a later slide, but I might as well bring it up now. We don't know. There is no confirmation in the forgiveness factors, because the language on costs looks at when costs are incurred and due, and it actually refers to both. But that doesn't seem like a practical reality, because how can you have it incurred and due within 8 weeks? That's impossible. So we get a lot of questions like, what about pay period end date versus paid date? And what I'm looking at for now, I'm telling people to manage it on a cash basis in terms of tracking, because you have to do something now because you're spending the money. And the reason being, and you guys can chime in, but the reason being I'm telling clients that is because I'm thinking about it from the lender perspective and what are they going to ask for in forgiveness. So, and we're going to talk about that in the slide in terms of they're going to need to verify these numbers in an easy, quick way, because they're going to have a high volume of forgiveness applications. the same way they have a high volume of loan applications. And so if they have a high volume of forgiveness applications, the easiest way, and the way they did the loan app, is to look at payroll. And payroll reports are a cash basis method. You're not looking at the pay period end dates. The reports run based on pay date. Taxes are charged based on pay date, not pay period. So it's in line with, you know, IRS methods. It's in line, and if you're doing other tax issues. So for that reason, I'm saying let's track cash right now.
Okay.
And then we'll get into more of this on which utilities later. Does that make sense, John? I mean,
yes, it does. No, I'm with you. I just wanted to make sure we covered that. So let's move on here.
I understand. Okay. So 75% is the guideline based on the, it's not in the actual language of the CARES Act. So everybody gets hung up on the 75% rule, but that's one thing, you know, Andrew and I have discussed multiple times, is that this is not a fixed percentage. It's a moving target here because it was presented as a guideline based on the following rationale, which the SBA and Treasury explained in one of their guidance that was published. It said, okay, well, we're giving people 2.5 months of the 2019 average payroll. If you want to follow along with me under the Y 75%, then 2.5 months is about 10 weeks. And for those of you who do payroll, you know, okay, that's not actually 10 weeks because not every month has exactly 4 weeks, but whatever. Then forgiveness is tied to how funds are used during 8 weeks after the receipt of the funds. And so they're measuring, and we're going to talk about that more later, but the 8 weeks starts the day you get the money. So if payroll levels are maintained for the 8 weeks, that's 8/10, which is, you know, about 80%, rounded down about 75%. So we're rounding here. We want you to spend at least 75% of the money on payroll. So it's a guideline. It's not an absolute threshold, but all or nothing forgiveness. It's like a good guideline to know, and you'll see in our example how to account for it in the whole scheme of things. We'll give you some sample calcs at the end. But absent fraud, you know, you're using this to pay people, you're earmarking it, you're being responsible and documenting. I wouldn't be too concerned about the 75%. Forgiveness factors, another forgiveness factor is, so that's just a guideline, right? The 75-25. So now you're like, well, what are they going to look at? How do I get this loan forgiven that they just gave me or that they're about to give me? So it's not available at all unless you spend the money on what they want you to spend it on. So the maximum forgiveness is going to be tied to the receipt of how you spent it. If you spent it during those 8 weeks on payroll costs, utilities, and rent/mortgage interest, which Andrew already touched on the interest with the issue with interest on the forgiveness side, that we're waiting to see if you can count things like business debt interest, transportation lease interest, things like those. But the amounts paid during the following 8 weeks is the maximum forgiveness. So if you take out, you'll see in my example, $750,000 and you only spend $705,000 of it, that's the max you can get forgiven, right? The 45 that you didn't spend on those items, you can't be forgiven. So now your total forgiveness is reduced to how you spent it in the 8 weeks. So what are these items? Payroll cost was one of the first ones, and that's pretty much the same as, it's the same equation you're familiar with in having applied for the loan. It's gross payroll. And note that it's not the equivalent of Box 1 W-2 income. I've had some payroll providers that were running reports of Box 1. Box 1 is not it's going to be less pre-tax deductions, other things, so it's not gross payroll. You want all gross payroll, and that includes severance, vacation, commissions, etc. Okay?
Rebecca?
Then you want to add on top of that.
Rebecca, would that include bonus payments?
Yes. That includes bonus. Anything that's cash, there's going to be a cap on that cash, which I'll just mention now. The cap is up to $100,000 per person annualized, which works out over 8 weeks to be about $15,300. You take $100,000, you divide by 52, and you multiply by 8, and that's the maximum gross payroll you can count per person. So if somebody makes $140,000, you can only pay them for, or if they make $16,000 during the 8 weeks, you can only count the $15,300.
Okay, and we've gotten several questions about that and payroll matters. I'm just going to run through a few of them right now. we've got one. Can you use the funds from the loan for retroactive pay? In other words, to pay a bonus that was earned in a previous quarter, not earned in the covered period?
Again, if we're going to pay dates, then that's going to be generally okay, but we're hoping to get guidance on that soon. It depends because there's a lot of wiggle room in terms of, well, how long of a prior period was it earned? Is it something you regularly pay out now? I think ultimately the SBA is going to be auditing for fraud, right? So are you just throwing in bonuses that, that aren't really justifiable wages to pass on and just giving those bonuses to the owners? That's going to be a problem, right? But at the end of the day, there are also self-regulating systems in here where you have the cap that you can only count so much per person.
Okay.
So I don't care if you get it as a bonus, right? So you have that self-regulating cap there. In that extent, I would say initially yes, but I would need more information about the specific scenario.
Okay.
The costs related to the continuation of group health care benefits, periods of paid sick, medical or family leave, all of those employer portions only. These are expenses you're paying. You can't claim credit if your employee is paying the expense. So when your employee has portions of medical held out of their checks and everything like that, that is not an expense you're paying. You can't claim to be using PPP loan money for it. This is an area where we also need clarification, where costs are incurred, period where costs are due, or both. For example, union healthcare contributions. I'm going to be paying my April ones in May. The benefits due in April or earned in April are paid to the multi-employer plans in May. So what do I count, based off of accrued or based off of cash? I think if you're consistent along the way, it's going to be equal. For example, if you're paying them, I don't care when it's earned, you're basically making monthly payments. So you're counting for 2 months, right? It shouldn't really matter if you're doing cash or the period earned, but going with cash would be consistent, because then if you're getting cash, if you're making a cash payment in the beginning of the 8 weeks, that's covering the prior month. Then when you get shorted on the back end by not getting to count the last 4 weeks, you're fine because it's all a wash. Permissible expenses for the remaining 25% include interest on mortgages, rents, utilities. The service agreement has to be in existence prior to February 15th. So don't go out and rent yourself a new fancy place. That doesn't cut it. It's like whatever old shack you were in on February 15th, you got to stay in. Andrew, do you have anything you want to add on that? Because you were talking before about the interest, and I have the note there.
Yeah, no, I think that's kind of just something to be aware of. One thing, at least on this slide, I'll note, because I think we had a question about, is in terms of the types of utilities. Generally, this is going to cover electric, gas, water, transportation, telephone, and internet. And that's kind of the grouping for utilities that the CARES Act provides.
Yeah, I think, and cell phone bills, whatever counts as a utility, I would also look at for now in terms of the tax code, since the Treasury is helping to interpret and issue clarification and guidance on this. I've noticed that they pulled some of those kind of definitions, so.
Right.
Okay. So now you get your maximum amount and you're spending it on, whatever you spent on payroll or these other permissible expenses that, that 25% is supposed to be allocated to. And we don't care if you do that in a 90-10 ratio, as long as you spend, as long as you're exceeding overall, the majority of it's going to payroll, it's not an issue if you exceed. 75 is a minimum. 25 in regards to the other expenses are a maximum because they want most of it spent on payroll. So you take that total loan amount or the total expenses, and now we say, okay, well, how much of this? Is there any ties? Is it going to be reduced further in terms of forgiveness? So how it might get reduced is if you have a reduced head count, and it's not all or nothing, it's a percentage. So you have a numerator and a denominator. The numerator of this ratio that you're going to multiply your total loan balance by, or your total expenses by over the 8 weeks, is the average number of FTE employees per month employed during the 8 weeks following receipt of loan proceeds. And here we don't know if FTE is 30 or 40 hours a week. Usually in prior regs, like we had the same issue with healthcare reform and we waited for FTE to come out with guidance. You know, usually one person is one person. They're not going to make one person count as more than one person. So, you know, usually people are capped at like 40 hours or whatever the amount is. So if you're at least counting per head and going off of like a 40-hour number, or even if you wanted, I mean, I would assume that'd be like the most conservative to make the higher number. You could do that and to average your part-timers. If you have all full-time people, then it's not going to matter. One full-timer is one full-timer. Denominator of that equation is going to be the average number of FTE employees per month during February 15th of 2019 through June 30th of 2019. In this period, February 15th to June 30th, these are like magic dates it's a time period referred to in multiple places of the Act as the covered period. So, you know, that's the period you look back. There are a few exceptions, such as if you're a new employer or you want to look at maybe look at different things. For example, you could do the average of FTE employees per month during January 1 through February 29th, right? They give you some options. So you want to look at both of those and say, which one is going to give me a lower denominator? Because the lower my denominator and the higher my numerator, the closer my percentage is to 100%. Another factor that gets implied in your forgiveness is if you cut people's salaries. They're going to look at the salaries paid during the initial 8 weeks following the loan disbursement, and they're going to compare that by employee. You're supposed to compare that to the total salary or wages of that particular employee during the most recent full quarter. This one I see as a nightmare, and I don't know if Andrew or John, if you have any thoughts, because how would a bank even verify this on the lender side? I think this is something like you're going to have to be good about documenting and showing you did your analysis as a borrower and maintaining that, because that would be something that could come up in an audit. Would you agree?
Rebecca, that's an excellent point, because the bank under this act has the right to rely on your certification that this is what you used it for. Now, you need to bring in the number. The bank can't stick their head in the sand and just look the other way. They need to look at your documentation to see if it is in the ballpark, but they don't have to go behind the numbers and do their own due diligence of that. And that's one of the reasons, if you can put your money into a segregated account, it might be easier for the bank to do it. One of the questions we got is, can I just reimburse, put the money in a separate account and then reimburse my payroll bank account? I would talk to my bank before I did it. To me, that makes sense. Again, there's no guidance on what's right and wrong. It's just, I think you need to do something that is a very clear trail for anyone coming in to say, how did this money get used? So again, the bank isn't going to go back and check your work, but the bank needs to see something so they, in good faith, can say you did what you were supposed to do. Okay, go ahead, Rebecca.
The thing is that you can think about, and the thing is I'm thinking about this, and having done payroll myself back in the day, I mean, when you look at a payroll report, it is not easy. You're going to look at totals. You're going to, they can verify or double check your total payroll expense, but to trace back whether each individual experienced a cut is just something that banks aren't going to have time to do. So, but what you want to do is look at the first.
I was just going to say, if you also have a very good payroll system that can show that, again, what I think you want is documentation. And now's the time to be talking to your banker to say, what type of documentation are you going to want to see so that you're comfortable that I did this the way I said I was going to? I would rather you start that conversation next week as opposed to 2 days before you want to go in and ask for forgiveness. That gives you time to build your system and generate the records that the bank is going to need.
Right. So if you reduce someone, it only matters first if that reduction is more than 25%. If you are reducing people and you reduce salaries, I have one company that did like 5% across the board. Well, that's not going to be a problem. It's only 5%. Also, if you have employees that make over 100,000 annually and you reduce their salaries, nobody cares about the higher earners.
Hey, Rebecca.
I believe, yeah.
I was just kind of on that point with
Does
the
the
100.
slide cover what you were going to mention? Going to do this slide?
Yeah, I mean, yeah, you can go ahead with that. I was just going to mention, I mean, the CARES Act, yeah, they don't specifically apply this rule to high earners who make more than 100 grand, but if you do reduce a high earner below 100,000 to say 80,000, it's going to hit you on the front end because you're going to be paying that much less in terms of payroll costs up front. And so you will, at the start, be subject to be able to receive less forgiveness. So it's not like you could just cut, the CEO salary, for example, to zero and not have any adverse, consequence under this.
Right, because that would make no sense, because then it's like, well, why isn't that's going to reduce your maximum available forgiveness when you can claim up to that 15.3 a person? So if you don't pay it out to someone at least 100,000, you're going to be paying that back. So that's why, again, some of these equations are kind of self-regulating or built in, but the language itself in the CARES Act says we don't really care what you do to people that make over $100,000 a year. Then, even if you did any of these things, there's an option to fix it in CARES. We have no guidance. It's maybe like, what is it, Andrew, like 8 lines maybe of the statute, of 880 pages in the statute.
Yeah, it's pretty short.
Sorry.
No, I was going to say, we kind of have highlighted this, but there's some, kind of questionable time periods on how these all kind of play in together. So it'll be, we're expecting some guidance on, some specific applications of how these are to be applied.
Right. And so I'll give you the guidance that we do have, the whole, like from that whole half a page of this 880-page statute. Basically, it says, if an employer reduced headcount or salaries between February 15th and April 26th, because this was a 30-day window after CARES went into effect. So if you haven't reduced headcount or salary during that time, you don't need to worry about it, right? You're done. You're past the window. You have other concerns with addressing the calculation and maximizing your loan forgiveness. But you're comparing to your headcount on February 15th. And if you did that and your headcount went down or your salaries went down, there's going to be a way to fix it. And here's the problem with what we have. All it says is that you're allowed to fix the reduction by increasing the headcount of FTE employees by June 30th. What does that mean? The average FTE employees? Does this mean, and I've gotten the question already multiple times, does this mean if we hire everybody back on June 29th, we still get all the money? It's like, no. Or we still get it all forgiven? It's like, well, no, that's not going to work. Also, if you're hiring them back on June 29th, you haven't spent your money during the 8 weeks and given on permissible things with 75% of your payroll. So that's an issue too. So, we don't know what this means. We know that there's going to be a way to fix forgiveness, and hopefully we get these guidelines soon so that, so that we can actually take advantage of them if necessary. But I want to at least point that out there because for now, you're doing your best. You're maximizing forgiveness and focusing on that. And then we'll deal with the correction option if and when you need it, but trying to avoid that on the front end so you don't need it. Let's see here, I mentioned that. Oh, the other thing is too, is that, I don't stress over it because there were situations that employers didn't have control over with the best of intentions. We have nothing about what if somebody voluntarily resigned or quit? Why should that be held against an employer? Maybe it won't be because it automatically reduces the payroll money spent. And those monies get paid back. Or what about you have people all of a sudden out because they are out for 12 weeks to care for kids, or they're out for, because they had to be quarantined for a while and they're not in your headcount anymore on your payroll because they're gone on leave. So are you going to be able to count people on leave as still being in your headcount? So we have that issue to figure
Rebecca,
out. Then
Rebecca, we had a question come in. Says, can you reduce employees' hours if workload diminishes and still use PPP funds, or do you have to maintain paying a 40-hour work week?
I don't have enough information to answer that, but you're free to follow up with me directly in an email, which will be at the end, because I need to know if someone is exempt or non-exempt. I need to know what a lot of different situations in terms of comp and whether they have PTO, like how to go about structuring it.
Got it.
But happy to help. It's definitely a standard question. Okay. Correcting a reduction in salary. A fix is also allowed if you reduce someone's salary. So in the statute, all it says is if you had at least one employee with their salary reduced by more than 25% and the employer eliminates that reduction by June 30th, you're okay. Well, what does that mean? If you cut someone's salary by 50% and you eliminate the percentage reduction by June 30th, you're okay? Or do you have to pay all that money back by June 30th? Like, what does that mean? And what about when somebody shows up as a salary reduction because their paid time is being funded through FFCRA leave and credits, which we're going to talk about in a second on how that stacks up with this. Because if you're getting funded for payroll through the FFCRA program, you can't claim that as being your expense for purposes of the payroll protection loan. You have to give that money back. So are we going to have a way to make sure that employers aren't penalized for that, for paying out FFCRA leave and it not being, viewed as a salary reduction? What happens with the balance that's not forgiven? Andrew, do you want to talk about that?
Yeah,
this
sure.
Is more on your side with the lenders.
Yeah, and so they'll be rolled into a loan. I'm sure you guys have kind of seen in the promissory notes that have been issued that these terms should be included in there because all of the loans under the program are supposed to have the same terms, but so your loan should have a 2-year maturity from the date of the initial disbursement with the first 6 months of payments deferred, although interest will accrue during this period. Interest will accrue at a rate of 1% per annum. And then there's also should be no prepayment penalty in your loan documents.
Yeah. Well, a couple of things too, because now is maybe a break to mention it. I had a question come through that was about if you could increase pay for employees to maximize loan forgiveness, right? To increase your payroll costs. Obviously people bonuses and other things like that, you can spend that money if you're capping it at $100,000 on gross payroll. I don't think anybody cares if you give out more money because you're not keeping it, you're giving it out to employees. The question is also going to be, it's also tied to head count here. So if you lay off half your people and pay everybody else double, it's still going to impact your forgiveness ratio. So, all of these series of equations work together.
Hey, Rebecca, and kind of one thing on that just keeping in mind kind of the intent of the act is to keep people on payroll and keep them at their kind of status quo salary-wise. And so, kind of keeping that in mind with any decisions you make in terms of your historic pay practices is also important to consider. And sorry to cut you off, John.
Yeah.
That's okay.
And this is Rebecca. I have this. Let me mention the scenario before you get in. Like I'm referring to scenarios too where I have people, and it's not like a fraudulent thing, or we just want to hand it out to get forgiveness. It's that you have other employees, or maybe you're short-staffed because of other COVID-19 issues with people being gone. Maybe you have some companies where the people are just, leaving or walking out or not showing up because they don't want to come in. Like it's very hard to get your people in some cases. And so what happens is the others are then working overtime or they're needing to get additional pay because unemployment is so attractive. Does that make sense?
Yeah, and I think too, some of what some of our clients have kind of talked about too is hazard pay and implementing stuff like that, given the circumstance.
Yeah.
So I think in that case, then maybe a increase in salaries justifiable compared to what you probably used for 2019 numbers in light of the COVID-19 crisis.
And Rebecca, what I want to do right now.
There's justifiable reasons to increase pay.
Okay. Before we leave the PPP area, some questions we've got in. I want to run through those. So this is going to be somewhat of a hodgepodge, and I want to watch our time, but I do want to try to hit some of these.
Examples. We are.
Okay. Well, let me run
we're going back on examples.
Can we increase pay for employees to maximize loan forgiveness?
Oh, I just addressed that.
So you can. Cannot. Which one is it?
Yeah. Because there's reasons that you'd want to increase, as long as you're subject to the $100,000 cap.
Okay. Can you pay out vacation bonuses with the PPP funds?
I don't see any reason you can't. I've had some clients, because they're always looking at a way to maximize your dollars, and if you have people with vacation balances that are owed to them and they're not working right now and you want to pay them vacation time while they're out, because I have someone who said, well, you're furloughed and so we're not paying you vacation. Like, that defeats the purpose of furlough. So if you want it's a matter of, are these people better off? I mean, you obviously can't pay people vacation if they're working, but if you want to say, look, you're only working half time, so we're going to charge this against your vacation, I don't see why you can't do that. I had some people, and I think maybe, go ahead. I was kind of a different question, but maybe you'll get to it.
Well, we have someone who is got employees on a draw asking if they can prepay commissions. Yeah.
It's like we're in sync. I was just going to mention that because, like, I've had that other issue with commissions, and the thing is like, you can't, it was a situation with, like, paying back and stuff, and the way a draw works is if you don't earn the commissions, then, you're guaranteed minimum wage, but the rest go back. Well, that's going to be a problem because this isn't your money to claw back. The government wants you to give it out to employees as payroll. So I have a problem with that one, just under the common sense logic of it.
So,
one other thing, when you reduce headcounts, I got this question. When you reduce headcount, you don't have to hire back the same person. Like, if you had somebody quit and you hire back a new person, then, it's a placeholder. And I don't see why that would be, headcount is headcount.
Okay. All right, let's move on. Thank you.
Okay. So I mentioned FFCRA leave and requiring in that. So what I want to say is, again, there's no double dipping here. So if you're getting a payroll tax credit to fund the $200 a day or $500 a day, whatever leave they're eligible for, that's a whole separate seminar, FFCRA leave. But if you're getting that payroll tax credit, then you're not paying the payroll expense. So it makes sense that this isn't going to count towards your payroll cost, quote unquote, because it's not your cost. FFCRA leave is funded by the government. And then this question of, everybody's out of unemployment. Do I need to bring them back? Yeah, if you want to increase your head count, you got to get them back on payroll and hire them back. Or you have to hire different people back if they don't want to come back because they've found out what a great deal unemployment is right now. It can be different people. Qualified disaster payments, just to note that if you're implementing those, they do not count as payroll costs because those are expense reimbursements. They're not issued through payroll. They're great because they're not taxed as wages, but they're still a business deduction and all that good stuff. And you're maximizing dollars to the employees, but the downside is you got this 8 weeks that you have to spend payroll, and 139 payments may not be the best use of your money since it's tax free. It's not a payroll cost. It's not a payroll. It's a reimbursement, so it doesn't count as wages paid to your people. If you did it through taxable wages like housing allowance or auto allowances, and you're taxing that on payroll, that can count as a payroll expense. But again, subject to the $100,000 cap. But yeah. Okay, so now we'll go over some examples. Does that sound good? You ready? We have
Yeah,
one
that'd be
example
great.
primarily. So okay. So ABC Company obtained $745,000 in PPP loan proceeds. And right away, I'm just, telling ABC Company here, let's take your $745,000, either put it in a separate bank account or earmark it and create a specific general ledger where you're tracking the use and proceeds and how these funds are spent. But do something to maintain the integrity of how the money is spent and tracked. So right away, I went and calculated 75% and 25% to give you ballpark guidelines. Okay, we're going to want to get about 8 weeks of payroll costs around $550. And assuming the maximum loan sought, I also included the number of, okay, this means their weekly gross payroll in this example is about $68,800.
Hey, Rebecca, I think this kind of important point to kind of emphasize kind of what your math shows here is that because of the differing time periods with this 8 weeks of covered period versus 2.5 months that your loan was based on, it seems like if you're just going based on your existing payroll in virtually all cases, there's going to be some balance left, and you're not going to be able to hit that, necessarily hit that 75%, which kind of seems to be inconsistent with kind of the intent of the act, but that's kind of how the math plays out right now.
A lot of it, there's going to be a balance. I've had that happen with almost everybody. Most people have not exhausted their entire amount. In some cases, you get it down to a very small amount, but it's hard. And also, you're looking at that average weekly gross payroll that was based off of 2019 payroll. So that might not be the average weekly gross payroll now. But anyway, that's 8 weeks. So, okay, spending 75% on payroll. So now I want to figure out, as I mentioned, I can include if it's taxable income going on their W-2 or on their paycheck as gross pay, I can include it. So housing allowance, auto allowances, any cash compensation. It's just all capped at $100,000 annually, and I put the exact number for the 8-week period, which is $100,000 divided by 52 multiplied by 8. Now, general partners not paid W-2 wages. This was a recent change, and they may not have been accounted for in your loan availability because that came out later when the rules address sole proprietors and entrepreneurs and all of that stuff. But, you can count someone to take distributions or draws up to that $100,000 cap also. Andrew, I have not seen anything, and I don't know if you have, but I thought I've had some people say, can I take W-2 wages and a draw? And I've been telling people, no, it's one or the other, or total. Do you agree?
Yeah, I haven't seen anything specific on that. I mean, I think you could probably do it if, subject to that $100,000 per person cap, but I don't know of anything specific out there that says.
I mean, you can pay yourself more money. Right, you can pay yourself more money. That doesn't matter, but it's a matter of what you can claim forgiveness towards out of your PPP loan money. On top of that cap of the 15,384, you add also all of the following. So the employer share of benefit costs, the employer retirement contributions, and unemployment taxes, state and local. You do not get to count your employer portion of Social Med. Okay, it's not a huge amount, Medicare maybe, Social, but you don't get to count it. They've been explicit on that. I don't know why, but you don't get to count it. They're like, we're giving you enough money, you still got to pay your payroll taxes on it. You can count state and local taxes. Yeah.
One other thing I was just going to point out on the partners, because we probably have several people out there that are organized as a limited liability company. What you're going to look at in terms of permissible payroll costs is going to be really tied to what your tax status is with the IRS. So, if you have just one owner, you're going to be a disregarded entity treated as a sole proprietor, and otherwise you're going to most likely be following these same partnership type rules unless you have made a affirmative election with the IRS to be taxed as a corporation.
Yeah. Okay. So for unemployment taxes that are covered, sorry.
let me just back up on retirement contributions and benefit cost. How do you determine those? Do you just take 8/52 of what your annual cost is, or how does that work? Or is it actual what you the cash you paid during that period?
Right, because we have a variety of employers, and your retirement contributions can be set up so differently, and your benefit costs can be set up so differently. And right now, the language says it's the costs incurred and paid during the period, right? So, you know, this would only count for like half of the time then. So that's not right. But, you know, it says insurance premiums are covered as well. It says healthcare costs and insurance premiums, including insurance premiums. So that language leads me to believe that it's more than just the insurance costs. For example, if you fund HSAs or HRAs and you do that on, you know, then I look to, well, how do you fund it? What is your traditional method or mechanism? If you, can we, you know, even if you paid outside of this period, can we at least be conservative, or during this period, if it's representing a year's worth of earnings, can we prorate it and do 8/52, like you said, of the amount to figure out proportion to assign to the 8 weeks. We need guidance on it, though, because it's a big thing. Right. And in a lot of cases, retirement contributions are paid in the spring, and that's not unusual. And I have that question come up all the time. Maybe you don't have it, you know, where it's tied per pay. Some are tied per pay period, like the match. Those you can definitely count. I mean, that's going to be per your payroll, right?
So we'll wait for more guidance. Let's jump, because I know you got a couple more examples, and we're getting short on time. Okay.
This is the one example. We're almost done. Yeah. I just want to mention one thing, because I know we had questions before you go on. So the unemployment taxes, state and local, you only count what the employer pays. So that's to the unemployment office, like the IDES in Illinois. You're not counting the state taxes withheld from an employee's pay. They pay that. Okay? So in this case, it would be, you know, I used an example of about 6,000, 2 months of benefit costs. And in some union environments, I get, you know, $1,300, $1,400 a month in health and welfare contributions and pension contributions. So that's why I said, okay, 2 months of benefits, I'll put it 6,000 and then 15,000. And that meant the maximum approximate payroll cost per employee was going to be about 21,384. I didn't count in unemployment because I just couldn't figure that scenario out last night in this example. But you would add that on top of there too. Proration for the head count. This person had 30 average monthly FTEs during that period. That's the denominator, right? We know that number today. You could figure that number now. What you don't know is the numerator. You don't know the number of FTEs during the 8 weeks. I mean, okay, you don't know the last year's either because we don't have guidance, but you could make a good educated guess. And so then you take, in this example, they took 27/30. That's 90% is their forgiveness ratio. And because they only had 27 FTEs versus the 30, this also translated into the fact that their payroll over the 8 weeks was lower. And this number, 705, I just made up, a lower amount. But they spent 705 out of the 745,000. So 90% of the 705, because only the amount spent on permissible costs are forgiveness. And so that means their loan is eligible for 634,500 of loan forgiveness. And the other part would be given back. The 745 minus the 635. That's the amount would be, you know, either subject to repayment or returned. With salary reductions, in this example, they reduced salaries at 25% across the board, but since that's not a problem, they can disregard it. It doesn't impact their forgiveness at all. And we may be able to, in this example, fix it because we might be able to increase the head count. We don't have guidance on that yet. But if we did something over the 8 weeks to say, oh, look, we could, you know, really make a difference. It's 10% if we can get these numbers back up. Let's hire a few people and let's try. Then you make an effort to do that. And this, I'll let you guys talk about this a bit because it's on the lender side. This is just listed from the statute.
Yeah, this is very similar to what we've already spoken about, and we're going to be sending these slides to you, so move on to the next one.
Okay.
So we have, things to do, again, and I think the biggest thing to do right now would be, in addition to getting your documentation, go talk to your banker and ask him or her, what is it that you're going to want to see from me in order to make this loan forgivable. We will be sending these slides to you, so you might want to make sure you check your email, and if you don't see them in the next several days, check your spam inbox and add us to your safe senders list if you would. I believe, Rebecca, that's our last slide.
Yes.
So
and
I want to thank
just looking
everyone.
over the questions, and I think we got them all.
I think we got a lot. In the slides, you will have the email address and phone numbers. So if you have questions that did not get answered, if you have questions that come up subsequent to this webinar, please feel free to send them to us. We would encourage you to do that so we get this answered and you can make sure that your loan does get forgiven. We thank you for doing this with us, and we hope that it was helpful and that we can assist you further in the future. Thank you very much.
Take care, everyone.